Hello, everyone. Welcome once again to another edition of Under the Macroscope, our weekly podcast. And good to have Skybound Capital's chief strategist in the London office, Jabir Sadawala, with us again. We allowed him a 2-week break, and then he was back with a bang last week. We're going to talk a little bit later in the podcast about sovereign wealth funds and some of the challenges that they are facing at the moment. But before then, a discussion around European stocks that have had quite a week and rising to extremely high levels. Jabir, what does this tell us about what's going on globally? Is this a return to investor confidence across the board?
Hi, Matt. No, I think it tells us that the investor world is a little bit deluded right now, to be honest. I mean, so if you dial back a bit here, we've got a situation where um, quite a few emerging market central banks have been steadily hiking rates, some quite overtly. Um, And then on top of that, we have inflation data coming out of pretty much everywhere, showing that it's on the rise. Central banks constantly telling us that no, it's all transitory. You don't need to worry about anything. Um, and then the much-awaited U.S. news yesterday, again on inflation, which shot through the roof, both at a headline level, where it's now rising at the rate of 5% per annum. That hasn't been seen in a long time. And the core rate itself is still well over 3%. In fact, just sort of checking through my data, I mean, you've got headline inflation, which rose 0.6% on the month to 5% year on year. And then you've got core inflation, so that excludes food and energy, which rose by an even higher 0.7% month on month to 3.8% per annum. Now, remember, whichever measure you take, this is well in excess of the Fed's target range of around 2%. That's typically been their upper level. Now, I've been trying to sort of figure out why markets have reacted the way they have. I mean, for a start, US Treasuries really dropped quite significantly. So I'm talking about the yields now. In other words, the price of treasuries went up. Remember, they have that inverse relationship to the point that the US 10-year has now suddenly settled at around 1.45 or thereabouts. It's a very big drop. It should have been the opposite. It should have gone up significantly, which in turn takes its toll on the equity market. Instead, it's dropped, which means equity markets are thinking, great, we're back to the good times again. Now, we might be, I don't know, maybe it is transitory, but what we do know is at the moment, the momentum in inflation is definitely upwards. I don't think we'll really find out whether it's transitory or more permanent until by about year end. Yes, it's true that a lot of the inflation increases has been down to energy. But even now, they're running out of rhetoric there. I mean, they're saying that okay, well, that will eventually pass through, and yet we have oil prices at around $70 to the barrel, and I think the potential for it to go up is still quite significant. If you look at U.S. stockpiles, they are depleting now, which means that they've got to ramp up. And if you look at charts of the rig count, the oil rig count, particularly the whole shale oil industry, it hasn't picked up enough to actually churn out more oil from the ground. So whilst we're waiting for an investment in capex there, if we get it at all, um, you know, demand is far exceeding supply. That's the that's the bottom line. So I think energy still got more room to run upwards, which will disappoint people who think that it's had its day. But even energy aside, I mean, look at some of the other components. Food, for instance. The FAO issued another release yesterday that who suffers the most? It's the EM countries. We've spoken about this before. Um, And then usually the final stage is wages, and when wages start to increase on a more regular level, that's when inflation goes from transitory to structural. And now more and more economists are starting to argue that this could be the case. So coming back to what you started with, European shares, and indeed, pretty much across the globe, I don't get it. I just don't get it. But clearly, when yields drop, suddenly, growth and all of that is back in vogue. And suddenly markets have started to go up. But I would really exercise caution here. If people think that, you see, the problem, one of the big problems here is that I think people are looking at the US job numbers and thinking, and originally I remember saying that, over this quarter, I would expect to see something like 1 million new jobs created per month. And we're well short of that. But the reason we're well short of it is actually not positive news, it's negative news. It's because whilst companies are crying out for labor and offering more and more, we talked about, McDonald's last week. The reality is there are still people either on job benefits or just unable for whatever reason to get back into the market yet. And that's, how do you fill that temporary gap? This is the issue that I have. You can't suddenly make robots in rapid time. You can't just open the borders in a COVID environment and let migrants come in. And anyway, there's a sovereignty issue there. So what happens? This is now starting to feed through. So I think the US unemployment numbers are a red herring insofar as they're not suggesting in any shape or form that this is going to be a slower recovery. It's saying the problems are far more acute. And when people get off the job benefits programs, and when more and more people get back into the labor market, and when enough places have opened up that parents can then leave their kids at nurseries again, that's when you'll see a massive rise in employment numbers. That's when it'll come through. But right now we have a disconnect.
I must say, I read what seemed to be a fairly simplistic assessment of this surge in European stocks, saying that it was really off the back of reduced concern around inflation, but that's certainly not your view.
No, it's not my view at all. And I think it's a bit of a red herring. So when you take people, the central banks have been doing a pretty remarkable job trying to talk markets down. And they have the power to do that. I think some investors take what they say as absolute gospel. And then on top of that, people have looked at the unemployment numbers, as I mentioned earlier, and assumed that, actually, it's not that bad. So recently, week before last, this talk about possible tapering in money printing. Well, that's all been put back for now. So, you get the opposite, you get the reversal in markets. But there is nothing concrete out there to suggest to me that markets are warranted. I mean, it just, justify going up when we've got clear inflation worries brewing in the system. Now, if it's an argument that, okay, look, inflation is a good sign because that shows that growth is stellar, and there's enough power in the economy to keep things going, then that's certainly a plausible argument. Not sure that I agree with it, but it's certainly plausible. But it's almost like investors are turning a blind eye to what I think are the real facts, and they're just assuming on the spur of the moment that because yields have gone down, there's nothing to worry about, and inflation is not a worry. It's not how I see it.
I mentioned at the start of the podcast, we were going to refer to a topic that you raised with me over the previous week around sovereign wealth funds and the challenges that some of them are facing in the current macro environment. Would you care to elaborate on that one?
Yeah. So it was just some stats that I started Googling and I came across. So for instance, the world's top 100 sovereign wealth funds, come to total around $8.5 trillion. I mean, it's staggering. It's a huge sum. Now, leader of the pack is Norway's sovereign wealth fund. That's about $1.3 trillion. And they have returned, ever since it became a sovereign wealth fund in 1998, they have been returning an annualized 4.42%. Their long-term target has always been 4%. Now, the challenge they face is that much of that has come from the last decade. Well, as we know, the last decade has been an absolute boom time. You know, we've had record low interest rates, record low inflation, record low yields, record low unemployment. So is that really going to carry on? I mean, I think we can safely say it's not. So what do they do with so much money? I mean, another one as an example, you know, ADIA also being an oil-rich country. So that's the Abu Dhabi Investment Authority. It's not as big as Norway's, but still very sizable. I mean, it totals around just shy of $900 billion. You know, they have the same issues, frankly. It was registered. They've registered returns over 20 years of 4.8%, so closer to Norway's, and over 30 years, because they've been running that much longer, really, 6.6. So it begs the question, what do you do? Because if you're in their shoes, you've got to still try and make returns. And where are they going to, even if they want to maintain those levels of returns, which they've admitted is going to be a challenge. And frankly, I don't find those levels of returns particularly enticing. It's not something that would lure me to markets. Well, they're too big to go to the small guys, because I just don't think they want that headache on their books. You know, what's the point of allocating to a $100, $200, $300 million fund? They won't even remember they've got it on their balance sheet. And on the other hand, if you go to the ultra large funds who are awash with cash anyway, in fact, their problem is that they can't deploy the stuff. Well, how's that going to benefit the SWFs? So really, I think the options they have are going to be quite limited. They've got to look at much bigger cash absorbing projects like infrastructure. And I think this is going to be the big theme going forward now. You know, we're seeing, and on the back of that, commodities are going to do even better as far as I'm concerned. That's really their only potential saving grace. And with it comes one other risk, which is concentration risk, because how much do they end up allocating to, you know, any one particular sector? So no, I think I think they alone can change markets in quite a significant way. Whereas, you know, they until now, everyone's been able to play the same game.
Yeah, fascinating topic to look out for. It's one of those genuinely macro issues. The hunt for yield is on, but capacity could be a problem, as you say, concentration risk. So a lot of factors contributing there. As always, fascinating. I'll tell you what else I'm fascinated about, Jabir, is tuning in to find out more about what happened in Cornwall at the G7 summit. And maybe the first question is, well, did you quarantine for 2 weeks on the way in, all of you? No, I say that tongue in cheek, but it will be interesting to see what has gone on behind closed doors, and how much of what did go on behind closed doors emerges, and how that is going to play out across the rest of the world. So yeah, we'll keep an eye on that, and all these other topics that you have raised with us today. A reminder to all of you that the podcast is available on Apple, Spotify, and the Google podcast platform for Android, and all past editions of the Under the Macroscope podcast available at Skybound Capital's website, www.skyboundcapital.com. Till next time on Under the Macroscope, have a great week.